Hey, and welcome everybody. Patrick Prunty here. So excited to be here with you as always, alongside my colleague this afternoon, Aaron Byrne. Happy to have you, Aaron.
Hey, pleasure to be here, Patrick, and pleasure to be here with you.
Absolutely. These are always so fun, and we're taking a little bit of time out of a super busy time of the year for us in the private lending department. We're heavily in reconciliation of the second quarter, which just ended June 30th, and we're in preparation to release our mortgage fund's forthcoming quarterly distribution. We are scheduled to release that distribution on Friday, July 22nd, and a lot of our capital partners are super excited to hear those results. So as I mentioned, super busy in that process, but we are excited because the distribution once again this quarter is going to be strong and consistent. 2% is expected, which rolls up right on target to our 8% annualized number. I can also tell you that the 200 plus folks who previously chose to invest with us in our mortgage fund are really thankful they did so. This is especially true right now, given the volatility in the stock, crypto, and other financial markets. With all of this economic uncertainty that now exists due to inflation and the extreme rise in interest rates over the past few months, you can totally understand where everyone's coming from. The bottom line here is that the mortgage fund and our overall private lending department is non-correlated to this current economic turbulence. And I fully expect the mortgage fund, which is designed as a diversified, low-risk income fund, to march right through this current market. We haven't missed a quarterly distribution yet, and I don't believe that this economic turbulence will impede us from continuing to fulfill our mission. So thanks again for joining us tonight. We're excited to share the details of our overall private lending department and the comparison between the investment options that you have, whether being a direct lender or an investor partner in our mortgage fund.
Awesome, and thank you, Patrick. Hello again, everybody. As Patrick mentioned, my name's Aaron Byrne. My pleasure to be speaking with you. I'm an investment analyst here with the private lending team. So awesome to hear Patrick's statement about the fund and how it's doing. We're just really excited to be able to continue to consistently hit and perform the metrics that we went to and set out to hit when we first started the fund. As Patrick mentioned, we are going to be talking about the private lending department. But before diving into detail about that, I did want to just briefly touch on Marshall Reddick as a whole and the other services that we do offer. So you can see on screen, we have a full service brokerage with agents for buying and selling. We're also a white glove, hands-off property manager to help manage your assets and help make you more money. We're also a private financing firm, lending money to folks who are looking to invest in real estate, fix and flip, rental property hold, etc. As an investor, we have 3 different options for you. The first is real estate, rental properties that we also can help manage. Another is mortgages, that is the direct lending side of the business. And finally, we have the pooled investment funds option, which Marshall Reddick Mortgage Fund is a pooled investment fund. As mentioned, we do have a full service brokerage, and in the markets on screen, these are where we have our offices and our footprints where we're able to provide all those services to our clients. We do operate in other markets as well, but the ones on screen are where MR has a brick and mortar location and boots on the ground to be able to provide excellent service and customer assistance when needed.
Yeah, that's great, Aaron. Thanks for sharing. I mean, it's just important that everybody understand that we've really moved and changed the model significantly. And we've got these offices set up. So these are obviously our strongholds, right? But when it comes to all of the services and investments, we operate heavily in these markets as well as several others. These are just those where we actually have our own Marshall Reddick office.
Absolutely. Thanks for that additional detail, Patrick. So just touching a little bit on some other items we're going to be going through a little bit more tonight. As you know, stock market, real estate market, overall economy, what do you think? We'd love to get some feedback. We're always, I know for me, myself, Patrick, I love, hearing and talking with our lenders, with our investors, just hearing their opinions and their take about what things are doing, what they're investing in. And so we want to hear from you today. We're going to be launching some polls here shortly. And some of those topics of discussion that Patrick and I will also weigh in on is, what do you think about those overlying markets, real estate, stock, the overall economy? What are you investing in right now and why? We'll talk a little bit more about, as we mentioned, private lending, which has the two investment options, the direct lending side and also the pooled investment fund. We'll also touch briefly on the mortgage marketplace, essentially an MLS listing service, but for loans. And finally, we'll go into more detail about the due diligence site for the Marshall Reddick Mortgage Fund for those folks who want to dive in a bit deeper. And as I alluded to, we're going to go ahead and get started right away, launching a few polls. We want to hear from you. We want to hear what your thoughts are, what your sentiments are from the things you're hearing from your family and friends, from the news that you're listening to and reading and watching. We'd love to get some feedback. We're going to launch a few questions here, and we appreciate your participation as we go through them. The first one should be showing up on your screen here shortly. So if you would please just take a moment to look at that, engage, and also make a decision. We're going to be publishing the results here shortly.
Yeah, I mean, what do you think, Aaron? Is it a good time to invest in the stock market?
Well, it's certainly volatile right now, that's for sure. There's a lot of things going on.
Yeah, absolutely. An unknown time, I would say, and everything that I'm reading and the metrics that we're tracking. But we definitely want to get some of that crowd participation to kind of understand, is the stock market hit bottom? Is it going to continue to go down? Like, what are your thoughts? Just a couple of more seconds as we're collecting those responses. And we're going to go ahead and close this poll. Okay, we're going to go ahead and share those results with everybody. And so pretty evenly spaced, right? We don't have any heck no's. It's a good time to invest in the stock market. And actually a lot of people upbeat, right? About 50% indicating that it's a good time to invest in the stock market. From my perspective, I'm kind of one of those dollar cost average guys. I kind of just, invest all the time. And I buy a little bit on the way up and a little bit on the way down and try to catch an even keel number.
Absolutely, I totally agree. It really comes down to time horizon. If you need something right now with the volatility we're experiencing, maybe kind of speculative, but if you're playing the long game, investing in good companies and good underlying assets, I totally agree with you, Patrick. Dollar cost averaging is the way to go.
Yeah, good, thanks for that. Let's dive into the next one. So what do you think? Is it a good time to invest in real estate? What do you think, Aaron?
Well, we're definitely coming off a really hot season here, but as you know, there has been changes in the market within the past 60 days. Seeing a lot with the inflation and the interest rate hikes coming through. So the market is changing.
Yeah, it totally is. The interest rate rise is a very interesting concept. I certainly wish the Fed would have done this sooner and more incrementally.
I agree.
But I'm also not a career economist, so they probably know a thing more than I do. But it certainly put a shock to the system. I think a lot of folks I'm talking to are really kind of like, I'm just going to hang out right now and see what happens. But there's a couple other factors that are at play. Extremely low inventory. There's just not a lot of homes on the market for sale. And I think that's perpetuated by the fact that we've all purchased or refinanced in the last handful of years at 2, 3, 4% interest rates.
Great rates.
So it's like we're going to just kind of sit tight and like everybody else. So that's going to continue to keep that inventory low. I also think that the costs, right, when we talk about inflation and the cost for new home builders to build homes today, significantly higher than before. And so it's like you can't look to the new home builders to fill our void in that inventory. So I think all of those things from my perspective all kind of keep the real estate market pretty stable. I certainly think maybe there's an opportunity that it's cooled off and it might be coming down, maybe 5, maybe 10%, depending on what location geographically you're in. But overall, I think that 10 years from now, I think we're all going to be saying, man, I wish I would have bought more real estate 10 years ago.
Absolutely. I agree with that. And yeah, just to sort of touch on that as well, with the supply shortages also compounding the labor and material costs for new builders, I do think inventory, as you mentioned, Patrick, will be staying low. And, something to think about in terms of the real estate itself. We have been in such a historic rise in appreciation lately. And I think sometimes we forget that before the actual boom happened going into the 2020 COVID recession there, where we kind of had a shutdown for a little bit, the annual appreciation rate was kind of more steady eddy. And so if we come down, 5-10% off the appreciation rate that we've been having over the years, we're still going to be at reasonable numbers at a stable, consistent market. So I totally agree. I think in 10 years from now, we'd all be looking at ourselves, and if we didn't buy as much as we could at this time, we probably would kick ourselves and wish that we did.
Yeah. Yeah, but I think in this kind of quasi weird spot where everyone's a little scared due to the spike in the interest rates, right? There might be a good deal or two to be had, right? When you catch a seller that absolutely has to sell and might be a little desperate to do so, you might be able to lowball them and get a good one. But we've gone ahead and published the results, right? So again, very upbeat, right, in terms of the percentages there, and a similar spread. We do have a couple of heck no's this time, which we didn't when it came to the stock market. So maybe folks are a little more pro stock market than we are here at Marshall Reddick. But thanks for the participation there. We're going to go ahead and hide that poll. We've got just 2 more. Similar one, so we're going to launch this. How do you feel about the overall economy?
Again, this is the big one, right? It kind of affects the other 2.
Yeah, I'm not sure. I think sometimes there's government involvement, and I think that there's sometimes are some things that are out of our control, and I think they're trying to do the best that they possibly can, but I think sometimes they, overreact. I mean, I think when COVID hit, they were like, geez, we've got to just direct mainline cash to the system, and of course that's created this surplus and it's created this inflationary period that we're in. There's just a lot to think about right there. But so far, the labor market is holding strong. We're going to see a lot of those numbers coming up in the next couple of quarters. People use the term recession. By the technical definition, I fully think that we're in one already, even though maybe we don't have the GDP numbers from Q2. But when we think recession, we just can't think 2008. This is just such a different time and a different market than it was then, especially when it comes to real estate and to financing. But nobody has a crystal ball.
Mm-hmm. I totally agree. It's something that I kind of always look into as well when you're talking about real estate. Reading some graphs and some polls that homeowners in America today have more equity than they've ever had. And so there's plenty of still cash in the market. There's still plenty of demand. There's still interested people in services. So yes, like you said, Patrick, while there are items that are kind of outside of our control, and we're going to have to move through those as they come along, I agree with you in terms of the overall outlook.
Yeah. Well, we've gone ahead and closed this poll as well. And interesting here, right? We've had, again, a good spread, right? But we seem to be a little bit more negative from the crowd and the response when it comes to the overall economy versus the prior 2 questions, which were, was it a good time to invest in the stock market, and was it a good time to invest in real estate? So, that's kind of an interesting response from the crowd. So in terms of having some more people concerned about the economy, but still looking to invest in the stock market and in the real estate market. So thanks again for the participation. We've got just 1 more, and we're going to move on. We'll go ahead and hide that one. This is really great, though. We appreciate the overall sentiment from our really good crowd tonight. We have a good turnout. All right, last question. Is it a good time to sit in cash?
I think we might have a few more heck no's this time than we did on the other questions, Patrick.
I don't know. I think, a lot of people might be saying, yeah, I guess that's what you're saying. You might be saying, yes, it's a good time to sit in cash. There's a couple of ways to look at this question. Okay, when it comes to sitting in cash, certainly we believe that everyone should have some reserves, right?
Absolutely.
You know, you always need to have some cash available. That's not necessarily what we're talking about, but we're talking about someone like my uncle, right? My uncle's a great guy, he's retired, and you know, a couple of months ago, he just said, I'm pulling out everything out of the stock market and I'm gonna sit in cash. And I thought to myself, well, I can understand paring down your risk, right, and going into some more conservative stock market holdings with your 401k, but I certainly don't think that sitting in cash is the right move. With the inflation that's going on right now, I think sitting in cash is just the same as losing money. But I think the key is that you got to find something if you're not a stock market guy or you're worried about it. If you're not a real estate guy or you're worried about it, you know, or if it's crypto or whatever it is, you got to find something to pace the market, right? To pace inflation. What do you think?
I totally agree. That is definitely the name of the game. While you definitely can find investments out there, there's always some that are going to do well and outpace, others might fall under. But I think the name of the game when it comes to inflation is definitely to pace, to hold steady, to keep controlling your purchasing power, because the inflation will be curbed eventually. And at that point, you then will be able to take the earnings off the spread.
Yeah. So we published those results, right? Again, another good spread. We had some heck no's.
Yep.
Yeah, as you suspected, right? And we've got some no, it's not a good. That's the overriding theme there. So I think folks are generally thinking what we're thinking. Again, let's go ahead and hide that, and thanks for the participation. So again, from my perspective, it's like you got to kind of figure out where do you sit if we're all in agreement that it's not really a good time to sit in cash, or an overwhelming large portion of your portfolio is sitting in cash. It's like you got to find that spot, that fairly liquid spot that's going to be able to offer you that safe, consistent return, right? And so I think that as a part of this, and you guys might agree, is it a good time to invest in direct lending or the mortgage fund with Marshall Reddick and our private lending program? Right? And I think that the answer is absolutely yes. But the question is why? And to me, it's non-correlated, right? So when the stock market's jumping all over the place and the crypto market's in the tank, like all of that hazardous stuff that's going on out there, when you're in the lender position, you're in the bank position, right? You're not going to see those. You don't get those ups and downs, right? So when all those things are headed in one direction, whether it's up or it's down, you don't see the same general trend with your private loan investment. And it's diversified, right? I don't suspect that a lot of people have a large amount of their holdings, their portfolio, in private loan investments where they're literally playing the bank and collecting income off of interest and loan fees. I don't think that's the case, right? So I think that an investment with the private lending program at Marshall Reddick offers you some diversity, some optimization, some stabilization in your portfolio. I think that it's very consistent. It's very predictable, right? We've got real estate collateral and choice real estate collateral. We pick and choose the assets that we want to lend against, right? So good school districts, good areas with lots of jobs and that types of things, right? So it's the borrower who's taking the correlated risk, right? If the real estate market goes down, that doesn't necessarily affect the bank or the private lender unless you're over leveraged, right? But if we've done our job, we're lending at really choice LTVs, or loan to value, right? Which means that it's the borrower, when the real estate market goes down, that may be losing a little bit of equity on paper, but they don't want to lose that, right? Because they know real estate's going to come back, just like we all do, if it goes down, right? And so in that case, the borrower is just going to keep making the debt service payment to you or to the mortgage fund, whoever the lender is. Okay, and then of course, all those things I just talked about is that borrower equity. Okay, so if you've made a good, solid private loan, right, and you're the bank and you're collecting interest, there's no reason to be fazed, right, by all of this market turbulence right now. And so it's for those reasons that I think it's an excellent time, and any time really, it's just among the excellent turbulence. And I sort of touched on this when we opened. Right, all of those folks that are invested in the mortgage fund right now or in our direct lending program, right, they are extremely excited, right, because they haven't missed a beat, right? Their money hasn't gone anywhere. just like it has with stocks or crypto or so on, right? So those are my answers. Oh, and don't forget about cash flow, right? It just keeps paying you every month or every quarter, depending on which scenario you choose to go. Okay, so now that we've gotten through that and all the crowd participation and the sentiment from the crowd, let's get to the nuts and bolts here, right? Marshall Reddick lends money, right? That's one of our services. Now, that's not to you guys. You're not interested in borrowing money. You may be, right? But what you're interested in, what you're doing here is you're interested in learning how to lend money, right? And to invest dollars to earn dollars. But you have to understand, who do we lend money to and why do we lend money, right? We don't lend to primary residence, owner-occupied folks. We don't make conventional or conforming loans. We make all different types of loans. As you can see, we make rental or hold loans. We make renovation loans for value add projects, fix and flip. We even make infill new construction. We're not lending to Lennars or KB Homes and the big developers, right? But we're lending to new construction builders, and we also do some bridge loans, right? So those would be loans where maybe the wholesaler wants to close on the transaction before not improving it and just reselling it for a profit to somebody else. Okay, so varying different types of loans that we make, that Marshall Reddick arranges as the broker. Okay. Now we make non-owner occupied loans only. We make first lien position loans only. We make favorable loan to value loans only. And these are all really important for you as the investor looking at and vetting our program, right? These are the things that you want to hear. These reduce risk. Nice collateral assets, right? At the end of the day, the worst risk you have as being the bank and lending money is that you could have to have a default, right? And need to foreclose to take the collateral asset. So if you ask yourself one question, and hey, if I make this loan, if there's a default on it, right? If I have to own that collateral real estate asset, am I okay doing that? If the answer is yes, well, then you got no problem making that loan. And that's how we look at things. And that's why we only lend against nice collateral assets. We will lend to recurring, experienced, professional, and loyal borrowers over and over and over again. We do not lend to the weekend warrior. We do not lend to the rookie that has no experience, that's trying to learn how to flip property that's been so glorified over the past decade. We work with the true professionals. Right, and for all the folks out there that are trying to figure out who that is, think about the "we buy houses for cash" signs that you see around town. Right, those guys are really good at what they do in their marketing channels and getting a hold of sellers off market, or folks in a situation where maybe there's a death in the family and the kids are inheriting the property. It's those professionals that we're lending to on a regular, ongoing basis. And then, of course, my number one favorite, which Aaron, you could speak to a little bit, is the internal, conservative, and qualified underwriting.
Absolutely. And that's where I come into the private lending process. When borrowers are submitting that application and they're asking for financing, I'm stepping in to start essentially becoming a detective and diving into the nuts and bolts in the particular deal. Who is the borrower? Do they have experience? Where's the asset located? What school zone is it in? Do I think that the property has functional obsolescence? Is it a nice 3.2? Is it newer build, et cetera, et cetera? And I'm the one diving into actually figuring out what the actual value of the property is today, and based on the borrower's plan, what it might be worth if this was like a renovation or a fix and flip type of scenario. But on my side, I'm always looking to consider all scenarios and factors to be conservative in my valuation, so that if anyone loses out, it would be the borrower, not the lender. Because my goal obviously is to make sure that we continue, as we have for the track record of over a decade now, continue to produce solid, safe, and consistent loan investments for our capital partners, such as yourselves.
Yeah, and really good to have you on the call to give that perspective. And Aaron is one of the investment analysts that's on our private lending team, and you can consider him the one that puts the stamp of approval on his loans. So those loans that are assigned to him, that he's the internal conservative qualified underwriter, right? Those don't make it to our marketplace, which we're going to talk about, unless they get Aaron's stamp of approval. Right, and we've got a whole team of investment analysts that are well-trained, professional, and have a good long career with Marshall Reddick to understand how we do things.
Absolutely, Patrick, and thank you for that. It's great chatting. And on my side, though, there is the question. I mean, we are talking about on the front side, we have these borrowers coming to us for these opportunities, and we are making these loans to them, whether they're doing new construction projects, fix and flip, maybe they're doing portfolio for their rental properties, etc. But the million-dollar question really is, where does that capital come from that Marshall Reddick uses to bank their private lending department?
Absolutely, great question. And the answer is very simple, right? It's private relationship-based direct lenders. Many of you guys on the call are already direct lenders. Many of you are thinking about becoming direct lenders for Marshall Reddick's private lending program. And secondly, it comes from Marshall Reddick Mortgage Fund. It just so happens that the mortgage fund is our largest and our biggest single direct lender. Right? So we offer two options that bank our private lending department. You can either own the mortgage directly, own the note directly, and we're going to go through the differences between both. And if you don't like the idea of the single ownership and the all eggs in one basket, well, then you can seek the safety of the pool, right? Or the mutual fund, if you will. It's just our assets in our mutual fund are real estate collateral for loans. So we're going to dive in now and just give that comparison between what the direct lender situation looks like if you want to do that as your investment versus investing in the mortgage fund. Okay, so when it comes to direct lending, you own the loan, right? You then earn the interest paid by the borrower, and Marshall Reddick earns the loan fees to arrange the transaction. Compare that to the mortgage fund. In the mortgage fund, that it earns the interest and the origination fees, right? But the capital partners putting the capital into the fund earn a preferred return and a share of the profits. When it comes to direct lending, the direct lender owns the mortgage, right? So it's sort of a pro and a con. It's like you get to choose, but it's like if it's a $250,000 loan, you need all $250,000. Right? There's not fractionalization, there's not crowdfunding. And so when you make that choice, right, to fund that loan, to bank that loan, to become that lender, you bear the responsibility, right? So we have extremely low default rate, and that doesn't happen often, but it does happen. And if it happens, we're here to help you, but you are going to be the one that needs to make the decisions and take any financial responsibility if there is any. Going again and comparing that to the mortgage fund, the fund owns each mortgage. And so from your perspective, you're spreading your risk across the pool. So as a capital partner, and I've got a couple hundred of them already in this early stages of our mortgage fund, you own a piece of hundreds of mortgages, and you're putting in your capital with millions of dollars of other investor capital, right? And if there's a default, right, when there's a default, fund management handles that, right? And it's the fund that bears all that responsibility, right? So you then, instead of having all of the responsibility or all eggs in one basket, you just have a little tiny portion of that default if or when there is one. Going back to the direct lending, it's a constant battle to keep invested, okay? So this is the more active of the two options. And so what I mean by that is that most people, when they want to get into being direct lenders for us in our program, they want to be in the super short term, 12-month loan terms that earn, 9, 10, 12% interest. And that's perfectly fine. But those 12-month loans, Aaron, as I'm sure you would agree, they pay off on average of 6 to 8 months. And so when you get your money back, right, let's say you earned 10% for 6 months, but then you get your money back, that $250,000 loan we're hypothetically talking about, well, guess what? It's back in your bank account and it's earning 0. So when you factor in the dead time in between your mortgage investments, it really drags down your yield. So you've got to constantly battle to redeploy and keep that capital working when you choose to be a direct lender. When you're in the fund, you're always invested and you're always earning. That is until you choose to redeem or to take your capital out, right? Because that you certainly need to know, okay? When it comes to your ability to exit in the direct lending side, you can only do so at borrower payoff, which means that if there is an individual default on your individually owned mortgage, you have to stay in until you can get your money out. That might be some time. There's always going to happen, but it could be much longer than you had anticipated when you chose to invest in, say, a 12-month loan. Whereas when you're in the mortgage fund, you can exit when desired. And then I've got the 12-month minimum there because we do have a minimum required 12-month hold as a capital partner in the mortgage fund. Choice of mortgage and allocation, right? That's a real pro to the direct lending. You get to choose the collateral asset, right? And whether you're doing short-term loans, long-term loans, how much of your portfolio you're allocating into what you're allocating. When it comes to the mortgage fund, you're already liking the model. You've chosen the model, right? And you think that fund management is a good, wise steward of the capital based on our history and how we conduct business, right? And so you don't get any choice or allocation, but you know what the business model is and you're comfortable with the business model and you've seen the distribution history. When it comes to the responsibility to release your lien, we only make secured investments. And so at the end, when your loan or mortgage is paid off, right, you have to sign a document in the presence of a notary and it has to get recorded in the county where the property is located. We assist as a private lending department with that. Okay, but you still, again, as the direct lender with your name on the paperwork, you've got to actually do the signing. Okay, whether it's in the fund, right? It's the fund's name on the documentation. And so I, or one of the fund managers, is signing off on all of the release of liens. Again, so it's active versus passive, right? But given all the variables, the ROI or the return on investment is very similar, right? Some direct lenders, some that are like retired or that have lots of time on their hand. It's certainly not the doctor, the lawyer, the CPA, that works a full job and family and all of that. They don't have the time to stay deployed all the time. But the full-time investor, sometimes they can beat the fund or ROI. But I think overall, if you're looking for a more passive, it's the mortgage fund that would be the best place for you.
And I completely agree. That's one of the reasons why I'm personally a mortgage fund investor. I like the passivity. I know that once the dollars are in, they're earning, I get the opportunity to compound my interest. And as Patrick mentioned, I believe in the model, believe in the pool of investment funds, the assets that are the underlying security for the loans that we make. That's the choice that I made. But when comparing both of these options, direct lending and the Marshall Reddick Mortgage Fund, I think they both definitely have pros and cons there that fit each individual investors and their needs. But there is another question that sort of arises because both of these investments are pulling from the same investment pool with the same borrowers and the same loans. So do direct lenders compete with Marshall Reddick Mortgage Fund for those mortgage investments?
That's a good question. And sorry for the pause there. We're getting a lot of questions from the crowd, so I was just kind of reviewing some of those. But yes, there is competition between direct lenders and the mortgage fund, but it's healthy. And it's healthy for the growth of the overall program, which allows us to attract more of the best, most sophisticated, most professional, most experienced borrowers, those borrowers that we really want to work with, right? So it's helped the overall growth, which is going to make more direct lending opportunities and more opportunities as the fund grows. We'll touch a little bit more on that, but I did want to answer some of the questions quickly from the crowd. How are liens verified to be free and clear for the lender to be first lien? Well, simple answer, right? We get title insurance on every transaction, right? We're just like a bank, right? We have escrow, title, homeowners insurance, all of that stuff is standard, right? So whether you're a direct lender or it's the mortgage fund making the loan, we have a full Alta policy of title insurance to ensure that you're in first lien position. No junior liens allowed, okay? I have a question then about the origination fees on the direct lending side. That's irrelevant. I'm happy to answer the question. We charge a 2%, 2 points, if you will, a loan fee, right? But it's irrelevant because on the direct lending side, Marshall Reddick earns that. The direct lender does not earn the origination fee. The direct lender's income, being the bank there and choosing the loan, is 100% of the interest. We do not arbitrage the interest. Another question there is that talks about accreditation, which we're going to get to shortly, right? To be a partner in the capital fund, you must qualify and produce documentation that you qualify as an accredited investor. All right, so we might come back to some of these other questions that we have. However, we will be following up with everybody, and we're happy to get your questions answered more of in a one-on-one situation as needed. Okay. So when it comes to our program, right, we talked about direct lending and the mortgage fund. What's the breakdown? So today the breakdown is as following. We're managing 100 million total capital, right? And that's spread across. At last check today, it was like 618 loans, right? Active mortgage investments. And that number fluctuates every day. I mean, we're funding new loans every day. We're getting loans that we previously funded paid off every single day. I mean, this is a full private lending department, okay? But about 620 at last check, 618. The direct lenders today still make up the lion's share of that 100 million, right? So about 60% by capital, so about 60 million is spread across the direct lenders, and by investment, 70%. Okay, so 70% of the 620 so loans that are currently active. And then the mortgage fund, right, is the smaller side of that, right? It's 40% by capital, or 40 of the 100 million that we're currently managing, and 30% by investment. So one takeaway I get from there is that the mortgage fund is doing larger deals, right? The average size of the loan in the mortgage fund is significantly higher than the average loan size for the direct lenders. But that makes sense, right? Because the mortgage fund's an aggregation of capital, right, that we control. Whereas the direct lenders, you guys all have a specific dollar amount that you have that you're comfortable and able to contribute to each direct loan that you may choose. But the idea in showing this is so that everybody gets an overall understanding about what we're managing here, the size of this program, certainly not our first rodeo, right? And that there's good diversification even here, right? And where the money that comes to bank our private lending program.
Absolutely. And just to kind of touch on that as well, we've been referencing a lot about the loans that we fund, and the ones that are getting paid off, the ones that are originating every day. Where do you go as the investor, and where does the mortgage fund go as a lender to find and review and look at those opportunities? And the answer to that question is essentially the mortgage marketplace. On screen, there is a clip taken from our website that gives you a picture of what that mortgage marketplace looks like. It's easily navigatable from the homepage of marshallreddick.com. All you have to do is at the top ribbon, there is that invest dropdown. You would simply hover over that and click the mortgages option, which would take you to our mortgage marketplace. So again, just a sort of summary about that marketplace, it's an MLS, but for mortgage investments. Instead of having it show properties that are coming for sale, it shows mortgages that are coming available for investment. It's public. It's available for everyone to view. And we also don't take down loans that we have completed in the past either. Our entire history that we've done since starting the department is up there for anyone to review. So you are more than welcome to do your time due diligence, and actually looking through and seeing those thousands of loans made across the platform. And finally, as mentioned, this is where the direct lenders such as yourself or the mortgage fund will go to shop for mortgage investments. So there is quite a large aggregation of data in the marketplace. And I won't have time to sort of touch on all the possibilities and options that are available for you as an interested investor, but I did want to sort of touch on a few and what questions that mortgage marketplace can help answer for you. First one is what mortgage investments are available, or in other words, which ones can I fund? Which ones are open for investment? I have some dollars I need to place. Where can I place them?
And those change so rapidly. Extremely competitive marketplace. The loans that are available today will likely not be available tomorrow, right? But tomorrow, new loans will be available. And to quantify it, the private lending department at Marshall Reddick is originating around 50 loans per month.
And then in that same breath as well, after those loans, that are available, they would start moving through the loan life cycle. So for interested investors, how we got our 618 number from earlier of our total pipeline, how many mortgages are active? You can look at that from the mortgage marketplace. Another one is how many mortgages funded in 2012 or last month, last quarter, or even last year. Again, we keep all of our loan investments up on the marketplace. We don't take them down. So these are all questions able to be answered from the website. Also, who owns the mortgage? Is it a direct lender, or maybe it's the Marshall Reddick Mortgage Fund? And remember, if you're looking for who owns the mortgage, and you're trying to find the mortgage fund, look for that blue MRMF tag next to the property address. How many defaults? And what is the default rate? Again, we have the majority of our loans pay off in full, perfectly, just as planned. But as with the nature of the beast when it comes to lending, you will get defaults from time to time. We don't take any of those defaults down. We keep them up as available on our website that you can look at. You can review the particulars of the deal and also calculate what our historical default rate is.
Yeah, as I mentioned before, that default rate historically is about 2.25%. That's over the past 12, 13 years and several thousand mortgages. And also important to note that just because there's a default, it doesn't mean that you lose principal, right? That just means you have to take action, whether that's is a direct lender or the mortgage fund. Currently, the mortgage fund has 0 defaults. We will have some, right? But we currently have none. But that's where, I think one reason is we were good choice makers, right? But all of the loans that become available get that stamp of approval. So it's not that the direct lenders get bad mortgages, right? There is competition, but all loans that become available are approved, Marshall Reddick, fully underwritten. It's just as we showed, the mortgage fund has a significant, a certain restricted amount of capital, and it's out of capital all the time, right? And so the direct lender fills that void. And in fact, as you saw, the direct lenders got more capital invested as a whole than the mortgage fund does. So thanks for the info there on the mortgage marketplace, where to find it, what kind of data is available, and so on. So we're going to dive into the mortgage fund. And I have several questions coming in from folks. I'll try to get to those at the end, but I want to make sure we sort of stay on topic. So the bottom line is that the mortgage fund, it's an investment fund, right? It's managed by Marshall Reddick. It raises capital by issuing restricted securities. They're only restricted because there's no sale market for them, right? This is not publicly traded. You can't sell your shares or your capital position to another investor, at least without our approval, right? No, you can only get your capital back by the fund redeeming it for you. But that's regular and that's normal and that happens. And when you need to get your capital, we're going to be here to redeem it from you. Okay. But in return for your capital, okay, you get a consistent return on investment on a quarterly basis. Okay. When it comes to the fund and just a couple basic specifics, it's a $25,000 minimum investment, so very low threshold of investment. And to give you a range, my top single investor, my top partner, has a $5 million position, and I have several with $1 million, some with $2 million, and then I've got a whole bunch down at 25. The pure average is like 175,000. Okay, so there's a good range, right? So a lot of people coming in at 50, at 100, and as you're going to see, it's an open-ended fund, so you can contribute and withdraw as needed. But we have a 12-month minimum hold, so very liquid, right? You can get it out in advance of the 12, but there are some penalties, and we don't really want to get into that. So you only go into this knowing that you've got to stick in for at least 12 months. And then the returns that you earn are have two facilities, right? There's the preferred return and the profit share. And I'm going to dive into that here in a second. As we mentioned, the distributions are paid quarterly, and you must be an accredited investor to become a partner in the mortgage fund. Okay, the theme about the mortgage fund from my perspective is that it's a place to optimize, which Merriam-Webster defines optimize as make perfect, effect, or functional as possible. Okay, and it's like the bottom line here is that the mortgage fund can help make your overall investment portfolio perfect, effective, and functional as possible, right? It's a great place to park investment capital. Right? Maybe you're a little unsure about the market. Maybe you want to jump on some real estate 12 months from now when there's some opportunities that present themselves, or then you'll go back into the stock or crypto markets, whatever it may be. In the interim, pace that inflation, right? And collect at least that 8% target return that we've been producing. It's conservative, right? It's consistent, it's non-volatile, right? It's like a bank CD almost. Right? It doesn't have FDIC insurance, but who knows with the government these days, right? But it pays a significantly better return and very similar, like 12 months, right? That's your standard bank CD, right? I think we saw a sign the other day, you know, publishing like a 1.75% on an 18-month bank CD. I mean, that's ludicrous, right? Why not get into something that's non-correlated, that's consistent, not volatile, that's producing that 2% quarterly distribution? Right, add diversification to your portfolio, right, and don't worry about the overall turbulence that's having in the stock market, overall economy that we all saw in our polls earlier, and what we all feel right now. It's perpetual, right? It doesn't have an end date. The capital raise period continues. It's always raising capital. It's always returning capital. It's just like an open market. There's no end date. This fund operates in perpetuity. It's open-ended, right? So it allows for flexibility and liquidity, right? You can get out when you need to, or what's very common is people are like, yeah, let's give this a try. So they put in 50 or 100,000. Right? And then 3-4 quarters later, they feel great. They put in another 25 or 50 or 100,000, and they kind of continue to add to this. Someone like myself, right? I've got a significant dollar amount that I put in initially, sort of like Aaron, right? But then I add $1,000 every 2 weeks right off my paycheck. Boom, I'm just dropping $1,000 right into the mortgage fund, right? Those options exist. Right? So you can add or withdraw capital when needed. And then you can also, we had one of the questions that I'll answer right now, right? Can a 401k or a self-directed retirement account invest in the mortgage fund? Yes, but seek tax advice, okay? I'm not a CPA, right? And so self-directed retirement account or not, you should talk about this with your tax professional and the tax implications, right? It's a partnership. You're going to get a K1 for your share of the income at the end of every year, right? But for those considering putting in dollars from their self-directed retirement account, one of the major benefits here is that you can automatically reinvest your distributions, which is certainly you can't do that as a direct lender. You've got to take the monthly mortgage payments. And when you're taking those monthly mortgage payments, they just sit in cash at the custodial account or in your IRA LLC account, right? They're too small to redeploy into something else like you can in the stock market where you can reinvest the dividends, right? You can do that with the mortgage fund. Okay, This is a really important slide. Everyone, please take notice here. I'm going to walk you through the waterfall because everyone always wants to quantify, like, how much am I going to get if I make an investment here? Because we're talking about percentages. And in this hypothetical scenario, let's just say we have $10 million investor capital on hand. We have 40, right? Just so everybody knows, but I like to use easy round numbers so that we can get the math down correctly. So again, this is hypothetical based on 10 million. And if the fund earns a gross annual income of 15%, and by the way, these are real percentages. Based on our operational history, these are roughly the percentages that we are producing and we are distributing. So if 15% is the gross annual income number based on 10 million, that's $1.5 million of income. From that, we have to pay out third-party expenses such as tax accounting and legal fees, bank servicing fees, and so on. There is a management fee, right? So Marshall Reddick, as the manager of the fund, earns a management fee, right? And that's because someone's got to manage the affairs of the fund. The fund doesn't have employees, right? The employees, Aaron, myself, the whole private lending team, we're employees of the Marshall Reddick business, not the Marshall Reddick Mortgage Fund business. It's just an investing entity. So there is a management fee, very standard, 2% of 10 million annually, 200,000. So after we get through our third-party expenses and our management fee, which represent the fund's expenses, right? Then we've got to pay out our preferred return. So the investors get paid first, right? And that's in the form of 6%. That quarterly breaks down to 1.5% per quarter. But we're looking at all these numbers annually. So 6% of 10 million, 600,000, or 600,000 of that 1.5 gross income that we've earned. Okay. We then split the remaining profit 50-50. So if I walk down the waterfall here, I had $1.5 million. I paid out 100 for expenses. I paid 200 for the management fee. I paid 600,000 to my investors for their preferred return. And now I have 600,000 left over to be split, right? That represents 6%, right? That's 3% to the investors and 3% to Marshall Reddick. And that is where Marshall Reddick makes money. And I want to just come out and tell you that right away because there's no need to hide that. When you make money, we make money, and that's how it should be, okay? Any promoter or anybody that you're working with that doesn't want to come out and tell you how they make money, that doesn't sit good with me. So in this scenario, when the fund earns 15% annual gross income, which is $1.5 million on 10 million, right? The investors earn 9%, which is 900,000, and Marshall Reddick earns 5% or 500,000, right? So it's a partnership, and we can't do it without your capital. So quantifying that all the way down, if you're a little bit under the average, right? We got about a $175,000 capital partner average. If you put in 100, you should expect to earn $2,250 per quarter, which is $9,000 per year, right? And right on our due diligence page that we're going to talk about next, you can see that our annual since inception return is 8.86%, right? So that is the waterfall. So quickly talking about the mortgage fund due diligence site, the URL is at the bottom, right? That's where you can find it. And this due diligence site was set up not only for people prospectively looking to invest in the fund, but also for current investors to stay on the up and up about what the portfolio holdings are. And this is a spatial or diversity map. That's what I call it. This represents, as of today, right before we held this webinar, where all of the 172 mortgages that the fund owns are located by state, right? So this and many more details are available on that mortgage fund due diligence website that can be found at this URL. I don't have time in this session to show you the actual page and to walk you through it, but some things that you'll find on the due diligence page are the request for portal access. Don't forget, we have an investment fund portal. This is where you can track your contributions, your distributions, change your election to reinvest versus take the distributions, download your year-end K1s, all of those things that you do, like if you are a rental property owner and you have a property manager portal, same concept. But you're going to also be able to see what the annual return is, right? You're going to be able to see how much capital we have on hand, right? You're going to see what are the actual mortgage investments in real time. You're going to be able to see the organizational documents, right? And the structure and the purpose all written out about the mortgage fund. What are its business plan? The diversity map that I just showed on the prior screen, right? Some other diversity statistics, right? What are the loan amounts? What are the property types that we're lending against? The collateral property types? What are the loan terms that we're lending against, right? And so on. The distribution history from the beginning, right? And an investment growth calculator, and then some details and some frequently asked questions. So it's a pretty robust website set up in a very easy to understand manner. Again, here's the URL.
Great. Well, thank you, Patrick. A lot of great information there, and highly encourage you all to, if you're interested in looking and learning more about the mortgage fund, to take some time and to look on that webpage. We'd be happy to answer specific questions one-on-one, but that page is a great launching pad for prospective investors and current investors, as Patrick mentioned, just to keep tabs with the fund and what's currently happening in the portfolio.
And Aaron, just myself, very, very knowledgeable in the fund. He's been here since day one. And the bottom line is that, he has a significant position in the mortgage fund, just like I do. And he understands the nuances. He sits in on all of our management meetings and so on. So if you'd like to chat with him, we've got his contact information on the screen as well.
Well, thanks for that, Patrick. And yes, happy to speak with you at your convenience. Now, we're wrapping up here. We just wanted to make a couple points. One is 5 steps to invest. If you are interested in getting started, the first step is to speak to a fund specialist. Patrick, myself, other folks we have here at Marshall Reddick Real Estate, we'd be happy to help answer questions for you, learn a little bit more about what your goal is for the investment, and help hash out the details and make sure that you're fully equipped to make a good decision in terms of if this is the right fit for you. The next step, if we're moving forward, is accreditation. And essentially, there are 2 ways to be an accredited investor. This is a Securities and Exchange Commission definition, SEC definition. Won't go into too much detail here, but essentially, you can qualify based on net worth, or you can qualify based on income. When you speak to a fund specialist, we'd be happy to go into further details there and see which qualification method works best for you. Next is to set up your investment fund portal. As Patrick mentioned, there is a portal, an investment fund portal through AppFolio Investment Management, which will allow you visibility into your investment and into the fund's returns. Next will be the signed paperwork. There's a subscription agreement based upon the private placement memorandum of the fund that essentially just details the specifics about the investment, who owns the investment, how much, etc. And finally, wiring funds. It's that easy. We'll provide you with the wire instructions to the mortgage fund's Bank of America account and be able to walk you through that process and verifying instructions and coordinations needed.
Yeah, we do have some improvements coming to the investment fund portal. We're heavily involved in the technological advances and working directly with the AppFolio software engineers to improve that. So you soon should be able to sign your subscription agreement, and then you can already do that now in the portal, but you can then click to ACH funds directly through that portal to us, which a lot of folks that are already have positions and want to continue to contribute, right? It's kind of clunky to have to come through us and then wire the funds or mail a check. But there are some significant improvements coming there. So thanks for those steps. The portal is very important, right? You can get there from the fund due diligence website, and you can do that. Here's a little screen clip. You want to find under that Invest Now button, there's that investor login, and that's always going to be there. So my capital partners who can't ever find the URL that's at the bottom of the screen, you can always get there right from the due diligence page. And if you don't have access, you're not yet an investor, a capital partner, you can request access. So when you click that investor login, you get to this screen, which is where you would put in your credentials. And then down there in the bottom right, you've got that sign up. If you click that, you can put in your name and your telephone number and your email address, and then we will grant you access to inside to keep you going down the process of getting yourself invested and so on. This is what inside the portal looks like. You can see, as you can see, there's an external link. You can schedule a consultation with a fund specialist. There are the wire instructions for download, and then you've got your banner on the left side of the screen, which is all different places where you have things that you can do as a capital partner that you need to do regularly. So this has been super fun as always. We do have a couple of questions, so if people want to hang out, I'm going to try to go through as many of these as possible. One good question I have is regarding the presentation. If you'd like a copy of the slide deck, no problem. Send Aaron or I an email. We would be happy to email you the slide deck. No issue there. Okay. Another good question I have is who services the loans, right? And that obviously is coming from someone who knows a little something about private lending and that there's a mortgage servicer. So when it comes to the direct lending, right, and the mortgage fund, we have a couple of relationships with third-party loan servicers. Marshall Reddick is not a loan servicer. Right, so we don't service the loans. We function sort of as a customer service go-between, but there actually is a third-party servicer. We use Superior Loan Servicing. That's our recommended, but it's a totally unaffiliated business. At the end of the day, however, if you have your own relationship already with a loan servicer, we're happy to board your loan with whatever loan servicer you choose. Right, most folks end up going with our loan servicer, and then of course our loans, the mortgage fund loans, they are all serviced by Superior. Right, we just get excellent customer service there. Yes, to reiterate, you must be an accredited investor to invest in the mortgage fund. To get accredited, there's a couple of ways to do so. You can get a letter signed, a vouch letter, if you will, signed by either your CPA, your financial advisor, or your lawyer. One of those three parties that has a professional license, they can vouch for you to say, yes, you meet the income requirements, or yes, you meet the net worth requirements. That's an easy way to do it. There are some third-party resources available. For example, I use verifyinvestor.com. This is a third-party website that all they do is take your income or asset documentation and then have an attorney in the back end of their website, right, review that information and give you that vouch letter. It's like 50, 60 bucks. It's well worth it and very easy to accomplish. Okay, so we're going to go ahead and leave it at that. We appreciate everyone's time, Aaron, especially yours, and all of you that were on the call with us. We look forward to speaking with you, and we will be following up with you.
Absolutely. And thank you again, as Patrick mentioned, for your time. Really appreciate you just being with us here, learning more about our private lending program, and looking forward to speaking with you all soon.
Good night.